Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel that helps you save not only your money, but more importantly, your valuable time with short, concise, instructional videos. In the last video, we talked about how there are two sides to every trade and learned about the complex mechanics of short selling stock. Today, we're going to continue our series on options, but on the short side of the options trade. Just like stocks, you can have a positive or negative position on options. But short options work very differently than short stock positions because you don't actually have to borrow anything, and in certain situations, options can offer a much more favorable risk-reward ratio than short selling or even buying a stock outright. Before we get started, please take a moment to support my channel by subscribing and smashing that thumbs up button to help more people looking for quality educational content find these videos. Alright, let's dive in. If we remember back to the last two videos in this series, we defined an option as a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price prior to or on the contract expiration date. Now, this definition mainly describes how the contract functions from the owner's perspective, but the rights that are given to the contract buyer and the contract itself have to come from somewhere. Options function very differently than stocks because the number of available shares in a given company is fixed, while new option contracts can be created and closed at will, as long as there is a buyer and a seller that can agree on a fair price. In exchange for collecting the option premium, the seller technically writes a brand new contract and assumes the responsibility for delivering or purchasing 100 shares of the stock at the agreed upon price if the contract is exercised. Writing contracts and selling premium can be very lucrative, but at the end of the day, the option seller needs to understand and be prepared for the risk of option assignment before entering the trade. Before we jump right into a market example, let's use a real-world analogy to wrap our heads around this concept. Let's head on over to a hypothetical tropical island where we meet a humble mango farmer that sells his fruit to a local restaurant that needs a steady supply of mangoes for its signature dish. Mangoes usually sell for about $10 a piece on this island, but prices can fluctuate based on competition as well as supply and demand. To keep prices and supply consistent and reliable, the farmer and the restaurant decide to work out a weekly call contract that gives the restaurant the exclusive right to buy 100 mangoes per week from the farmer for $10 per mango. For this guaranteed steady supply, the restaurant pays $100 per contract. If we do the math, that means that the restaurant is essentially paying $11 per unit for a steady, reliable supply of mangoes. If a big shipment of imported mangoes comes into the harbor and floods the market, mango prices might drop all the way to $8. In which case, the restaurant might decide not to exercise its right to buy the farmer's mangoes and choose to save a little money by purchasing them at the market price of $8 instead. The farmer is okay with this deal because he is able to secure a buyer for his mangoes in advance and collect a little bit more than he normally would to increase his profit margin. If mango prices drop, he can still collect and keep that $100 contract premium each week and still sell his mangoes on the open market or try to hold on to them until prices recover. Now let's suppose for a moment that a massive typhoon passes by our small tropical island and cuts off all new shipments of imported mangoes. With a shortage of mangoes on the island, prices will likely skyrocket. In this scenario, the restaurant will be very happy that they invested in call contracts to secure their steady supply of mangoes at $10 a piece because they are protected from this price inflation. Unfortunately for the farmer, he will still have the obligation to deliver the same number of mangoes at the same price and will not be able to take advantage of the short-term inflated prices unless he has extra mangoes to sell beyond the 100 that he committed to selling to the restaurant. In this illustration, we can see how both parties can potentially benefit from using option contracts to regulate their transactions. But today we are talking about selling options, so I want to focus on the mango farmer's perspective. By selling call contracts over assets that he plans on selling anyways, he can continually collect contract premium week after week to support his operational costs and increase his profit margin. Investors can employ similar methods when trading stocks and options. Using calls and puts to help you enter and exit positions may require a bit more attention than simple stock transactions, but can help you secure better prices and decrease your cost basis with the premium that you collect. The first strategy that I want to look at is selling cash secured puts. This is a strategy to use when you are long-term bullish on a stock and would like to enter into a stock position, but you want to get the most bang for your buck. If you sell a put, you are taking on the responsibility of buying 100 shares of the stock at the specified strike price anytime between now and the contract expiration date if the buyer decides to exercise their contract. Let's say for instance you are long-term bullish on Uber, which is trading around $31 per share. You can buy it right now at the market price, like most long-term investors would, and your risk profile would look something like this. Your maximum gain is infinite because there's no limit to how high a stock price can rise, and your maximum loss is 100% of your investment if the value drops all the way to zero, which in this case for 100 shares would be a max loss of $3,100. Your break even where you neither make or lose money would be if the stock stays exactly at $31 per share. If instead we decided to use our knowledge and skills to initiate this position with options, we could sell a put to collect some premium up front and lower our cost basis, as well as our max loss on this trade. Maybe you think that $31 is a little high and you want a slightly better deal on Uber to enter your long-term position. You could choose to sell the July 17th put contract with an out-of-the-money strike price of $30. This contract expires in about 3 weeks, and Uber tends to be a fairly volatile stock, so you would realistically collect about $150 in premium. That $150 goes directly into your investment account and is yours to keep as long as you don't decide to buy back the contract before expiration. Theoretically, the risk profile for a sold put looks something like this. Your max gain is the $150 premium that you received with a break even at $28.50, and your max loss, which would only occur if the stock plummeted all the way to zero in the next 3 weeks, is the full value of the stock position minus the premium you received. If we quickly do the math, that's 100 shares of the stock at the strike price of $30, which is $3,000, minus the $150 premium, leaving us with a maximum loss of $2,850. At a glance, this risk-reward ratio doesn't look very appealing, because we are risking far more than our max gain. But since our long-term goal is to own the stock, if the price drops below $30 in the next 3 weeks and the option is assigned, we will purchase the stock and our risk profile will transform to look something more like that of a simple stock position. Assuming that we are assigned and purchase the stock at $30 per share, our long-term risk profile looks like this with a max loss of $2,850, a break-even price of $28.50, and an unlimited maximum gain. By using a cash-secured put to enter this long-term position, we can potentially decrease our cost basis by a full $250 or $2.50 per share by selecting a strike below the current market price and collecting premium from selling the contract. Now, if the stock price does not fall below our strike before expiration, then we will not be assigned and the contract will expire worthless. If this happens, we will not get to enter into our desired position, but we will still get to receive and keep the $150 premium, which is a 5% return on our capital investment in just 3 weeks. Many investors struggle to reliably get a 5% return in a whole year, so I would be more than happy to walk away from this trade with a 5% gain in just 3 weeks. We can then turn around and sell another cash secured put or move on and allocate that capital to a different trade. As the natural opposite to puts, you can use covered calls to also collect premium while you look for an opportunity to sell out of a stock position. Let's say that you acquired the Uber stock and it is back to trading around $31, but you are considering taking your profits. You could sell a covered call expiring 3 weeks out at the $32 strike price for about $150. The covered call caps your maximum gain until the contract expires, but can help you either collect a bit more than you would from selling at the current market price, or if the stock does not reach your strike by expiration, you can pocket that cash and hold on to the stock. You can even turn around and sell another covered call and keep collecting premium until the stock gets called away from you. With this trade, you are combining being long 100 shares of stock with a short call to create a single position. The max loss of this macro position looks similar to that of a standard stock position if the value falls all the way to zero. But even if that rare worst case scenario occurs, you will still get to keep the premium from selling the contract. So your max loss on a $3,100 stock position is $29.50. If the stock gets called away from you, your max gain on the position in the next 3 weeks is $250. If the contract is not exercised before expiration, you get to keep both the stock and your $150 in premium, and can turn around to sell another covered call and keep collecting premium. One important thing to note is that these strategies force you to trade with blocks of 100 shares of stock. there are no fractional option contracts that allow you to sell options on, say, 10 or 25 shares. This makes these strategies relatively capital intensive, and if you trade with a smaller account, you might find these strategies restrictive based on the stock price. Trading 100 shares of Uber only takes about $3,000 of capital, but trading 100 shares of Amazon requires closer to $250,000. If you trade with a smaller account, don't worry, there are plenty of other option strategies that will allow you to trade some of these big names with high share prices, but we'll leave those for another video. Before we get to that, we'll go more into depth about covered calls and cash secured puts, covering details on some of the best ways to use these strategies, as well as pitfalls and things to avoid. If you learned something today, please do me a huge favor and hit that like button and leave me a comment below. And please don't forget to subscribe so that you don't miss any of the future videos in this series. Until next time, keep calm, stay healthy, and happy trading.